Did you know that you don't need an LLC to unlock massive real estate tax breaks? Today, I'm sitting with Amanda Hahn and Matt McFarland, tax strategists and Bigger Pockets authors, to break down how short term rentals can slash your taxes even if you're a W 2 earner. From bonus depreciation to that one loophole that could save you six figures. This conversation is packed with gems. You don't want to miss it. What made two CPAs decide to specialize in real estate?
Well, I mean, for me, I'm the third generation of real estate investors in my family. So I always knew real estate was a good way, a good wealth building tool. But for me, it was actually Matt who convinced me to start getting into real estate for
It's
ourselves.
all my fault.
Yeah.
Yeah, no. Well, so Amanda and I, for those listeners who don't know, we are married to each other, but we met working at a Big Four accounting firm, and I happened to work with in the kind of the private client advisor group, but got exposed to real estate investors as well. And I mean, I still to this day, 20 something years later, vividly remember I was probably 2 or 3 years in working on a look reviewing somebody's tax return. Person was probably in their 60s, retired, all they had was real estate, but it was clear, looking at the return, if you add back depreciation, that he wasn't paying any taxes, but still making six figures in cash flow. And that's kind of when the light bulb went off. That okay, there's something here where somebody in their 60s can be making $100,000 in cash flow and not paying any taxes. Like okay, let's dive into this a little bit more. So from there it was just kind of like, hey, we like this, we understand it. It's kind of why we chose to kind of focus our niche on real estate.
I love that. So, Matt, I'm glad you mentioned that you two are married and you work together. That's something that a lot of our investors often struggle with. They may have a reluctant spouse, they may have someone who's not as supportive. So, question for you: how do you work together as a married couple in this tax business? Do you talk about tax deductions all the time? I know it's a spicy conversation, but would love to hear how that works.
Is this being
It is.
recorded? I just want to make sure before I choose my words wisely here.
Yeah. I think with any business that you're involved in with your spouse, it's good to understand, just like any other partner, right? Where are each of our strengths and weaknesses
Mhm.
lie, and sort of maximizing that aspect of it and being able to stay in your own lane and focusing on sort of your unique abilities. But as people who work with investors nationwide, we do see it a
Mhm.
lot in that scenario you described where one spouse is ready to jump headfirst into real estate, the other one is a lot more reluctant. And sometimes the numbers help make the decision. We
Mm.
might have somebody who is a high income physician married to somebody who has still a W 2 job but a lower income. And sometimes when we show them the numbers in terms of this is what real estate can do for you, here are just the things you should be doing during the year to be able to maximize the tax benefit, then it sort of sways them into saying, okay, this is something I can see how it would help our family build wealth, right? So sometimes it's in the numbers that help them to drive that decision to both get on the real estate train.
Mm. My husband, and I'm going to tell on him, was that reluctant spouse. He let me invest in our first property, kicking and screaming, y'all. So, launched that first short term rental. And then when we started to get the payouts, I still don't think it was registering with him. So, I would go to Chase Bank, I would withdraw the funds, drive home on my way from work, hand him the funds, and say, "Oh, babe, it's just been a busy day. Can you deposit this for me?" After the fourth time I did that, he goes, "What are you up to? Is this legal what you're doing?" There's something about cold hard cash that brings a spouse on side. And needless to say, he was bought in when he started to literally touch those 2,000, 3,000, $4,000 payouts, and he ended up retiring before I did. So you're absolutely right. The numbers, right? The numbers, either seeing it on a spreadsheet, seeing it deposited in a bank account, or seeing it as cold hard cash that you can actually touch, that turns a reluctant spouse into a believer for sure. So yeah, thank you for that reminder.
Yeah, and sometimes it's also hearing it from somebody else too,
Yeah.
right? So you telling your spouse the benefits of investing in real estate, and maybe your spouse sees you as kind of a crazy unpredictable
Hmm.
person.
Who believed in
What are you
And
looking at me
who
for?
believed in MLMs? It was like, oh, not another one of these, right?
exactly, exactly. But then when you talk to your
Hmm.
CPA or financial advisor or someone like you, Rachel, then they hear an outside perspective and say, "Wow, Rachel seems smart and she's done it, so we can do it as well."
Absolutely. So, what would you say is the most common mistake that you see doctors, pharmacists, dentists, healthcare professionals make when they're investing in rental properties?
I think probably time and time again, I think the biggest mistake we see, investors make, whether they're doctors, physicians, medical professionals, who else, right, is they just don't approach it like it's a business.
Mm,
For a lot of people, I think they approach it as kind of like, hey, this is just something I'm doing on the side. But the downside of that is that people aren't as diligent with their record keeping, their finances, their kind of approach to being strategic about tax planning, whatever the case may be. So they're missing out on deductions because they don't have good records. They're waiting till April to talk to their CPA about what happened last year, which really limits your opportunities and what you can do, obviously. So I think those are that's probably the biggest mistake, in my opinion, that we see time and time again for investors.
Yeah. And by business owners, we just mean you're in the business of investing in real
hmm.
estate, regardless of whether you have an LLC or a corporation or not. A lot of people tend to think that I can't take these write offs because I don't have a legal entity yet. But that's actually not the case. As soon as you start investing in real estate, you're a business owner. So now it opens up a whole new segment of the tax code for you. Maybe if you were a W 2 dentist and you couldn't write things off, but now it's different. Now you're a business owner and you're able to capitalize on a lot more of these tax benefits that you couldn't previously.
Okay, so tax benefits. Can we talk for a moment about the new tax bill called the One Big Beautiful Bill? I believe that's the technical name. What would you say are some of the game changing benefits for those who are investing in real estate? And we can even go a little bit granular into which specific types of real estate investing strategies are going to be the biggest winners with that bill.
Well, first I'll say that is the actual name of the bill, which is interesting. A lot of people ask that
Okay.
question. Is that actually the name? And yes, it is. What I really find interesting, it's called the One Big Beautiful
Okay.
Bill, is that it is pretty encompassing in terms of if we look at recent history, this is a bill that actually does provide tax benefits across a whole spectrum of different types of taxpayers. Obviously, we'll be talking about investors here today, but also for someone just as an individual taxpayer, because investors are also individual taxpayers
Mm-hmm.
too, there are new incentives for homeowners, just people who own a home. We can write off more on our primary home property taxes and personal state income taxes than we would under the old bill, about 4 times as much as what the old law allowed us to do. And there are incentives even for people who get paid overtime. Again, even if you're a dentist or physician who gets paid overtime, you potentially get some of that income to be tax free, which is a brand new thing that we've never had before.
There's also another brand new thing that may apply to some people out there is for those people who are buying a new car with using loans, they can now deduct up to $10,000 of interest paid on that car loan, which never existed before, unless you were using it for your like business or something. But just a personal vehicle, you've got a loan on it, you're paying interest. Now people can deduct up to $10,000 of interest on that car loan. So now the vehicles does have to be primarily I think the wording is primarily manufactured in the United States, something like that. But that's interesting that that wasn't around. Before you could only deduct interest on your primary residence or a second home, but now you can deduct something on a car too, which is interesting for sure.
Real estate
Yeah.
specifically for us as investors, obviously the revival of 100% bonus
Yeah.
depreciation. If you take a look at the law before and after the One Big Beautiful Bill, the tax benefits more than doubled. Because under old law, we only were able to access 40% bonus. Now we're at 100% bonus. So for investors who are able to use these tax benefits against W 2 or other business income from their medical practice, it's pretty significant to be able to more than double your tax savings on the same property.
So for those of us who are very well acquainted with it, that was a big win. However, for those of us who are rather new to the strategy of leveraging bonus depreciation, leveraging 100% bonus depreciation, can you speak to that a little bit? Because some of our docs, they have some long term rentals, some of them have some short term rentals. Who would qualify for that 100% bonus depreciation in terms of which strategy is going to be the most ideal for a working W 2 or 1099 practitioner?
Yeah, I mean, I think I guess in general, maybe it's worth mentioning, like, I guess what is
Yeah.
depreciation for those people who are listening who don't
Hmm.
know. Um, it's kind of we call it this gift that the IRS or Congress gave us years ago, where they say you got invested in rental property, and I guess comparison purposes, you go out and buy stock, you buy Google stock. You don't write off the cost of that stock right now. You don't even write that off until you sell the stock down the road. But with a rental property, they say, hey, because of normal quote unquote wear and tear, we're going to let you write off a part of the purchase price every year against the income you get from that property. And so, long term rentals, the buildings are depreciated over 27 and a half years. Generally speaking, residential properties. And then short term rentals can be depreciated over 39. So basically, it's a way to shelter some of the cash flow you get from your property from having to pay taxes, which is great. But then, the question comes up, well, how can we utilize more depreciation faster? That's great. I can spread out my deduction over 27 and a half years, but what if I could take more of it sooner? And that's kind of where bonus depreciation comes in, because certain things in a building, typically 5-year and 15-year assets, like furniture, appliances, landscaping improvements, those kind of assets, they qualify for faster depreciation, but then you throw 100% bonus depreciation. What that means is you can expense 100% of that stuff right away instead of spreading out that portion over 27 and a half or 39 years. So you can kind of see conceptually how that could be a huge benefit for people who are trying to reduce taxes now versus later, for lack of a better term.
So when you hear people say, I use real estate to wipe out my income for taxes or, cut my tax bill by half, typically that's what people are talking about, right? Using the depreciation paper
Hmm.
loss, and they're not saying I lost
Yeah.
money on my rental real estate to get
Yeah.
to it. But I think you had a good question about who is able to take advantage of bonus depreciation. It's actually everyone,
Hmm.
regardless of whether you're investing in long term rentals, midterms, or short term, if you are doing real estate full time or part time. Everyone is able to take advantage of 100% bonus depreciation under the One Big Beautiful Bill. Now, the question though is, should you be utilizing accelerated depreciation? And the answer to that depends on how and whether you can use it to offset the different types of income you have.
Mm.
So you had mentioned, well, what if I'm working full time, I'm a practitioner, 1099 income, or just a W 2 income? If real estate is your side hustle, then the short term rental market generally will provide better tax savings for you. And the reason for that is what we call the short term rental tax loophole. The reason we call it a loophole is because it is one of the few asset classes within real estate where you can invest in something, get the tax strategies, and use it to offset taxes from your W 2 income, even though real estate is sort of a side hustle. In the other asset classes, long term and midterm rentals, typically real estate has to sort of be your main occupation in order to use it against different types of income.
But what about an LLC? Do I have to set up my business and have an LLC or an S corp or a C corp? Can we talk a little bit about that? Because I get that question asked a lot, and I said, you know what, you need to speak with Amanda. Let her answer that question for you, and Matt, of course.
Yes, yeah. That I
Yeah,
mean that's
we get that question all the time too. And it's a common misconception
Yeah.
out there. As Amanda was mentioning earlier, people think that you need to have some sort of legal entity to take tax deductions, and that's the farthest thing from the truth. You just have to be involved in a business to take tax deductions. That could be rental real estate. That could be maybe you're a real estate agent. You've got that business. You can take deductions against that. So it has nothing to do with the legal entities. So for rental properties, people definitely utilize, for example, LLCs to hold title to their real estate. But that's from an asset protection standpoint, and it really has no bearing on income
Mhm.
taxes. Now, if you're in an active business, real estate agent, fix and flip, wholesale, there are times when maybe using an S corporation can make sense in that business. But generally speaking, we don't want to have S corps or C corps own title to rental real estate for various tax consequences that could arise down the road.
Love that. So, what would you say to that burnt out, busy dentist, physicians, pharmacists who is thinking to themselves, okay, I think I'm picking up what you're putting down. What is their first step when it comes to mapping out this strategy so that they can start taking advantage of it right now, because it's live, it's available to us right now as of after January, right? 2025, January 19th, something like that.
Yeah, with respect to anything, what we look at is creating a roadmap or a blueprint, right? And so it starts out with where am I
Mm,
today? So, as a dentist, for example, where am I today? What are my finances specifically? What are the things I have to work with to get to my ideal goal, whether that's passive income or tax savings or both of those combined? So, we're looking at how much do I have in the stock market? How
mm,
do I tax efficiently move it over to real
mm,
estate? How much equity do I have in my home that might be what we call lazy asset? It's just sitting there doing nothing. Can I tap into that without paying taxes and use that to get into my first or next rental real estate? And from there, then the conversation becomes what type of property makes the most sense for me? If I'm still working full time or operating a business in medical field full time, then the short term rental investment might make the most sense for me because I can do it as a part time thing and potentially use the losses against my non real estate income. Alternatively, if I'm married and I have a spouse who is not working full time, well, then I can invest in almost all types of real estate because maybe my spouse will be interested in becoming a real estate professional, which then allows us to use all of these tax benefits against the different types of income that we have. So the
Or you're single and ready to mingle and find a real estate professional. I mean, that could always work too.
yes,
We don't want to leave out the single
that's a
people here.
strategy,
that's true.
yes.
Yeah.
Yeah, that's a tax marriage strategy right there.
Yeah, so if you're a high income earner and you're single, your two options are one, marry a real estate professional, or two,
There we go. There we
short
go.
term rental investments. So we've just added
Right.
dating advice
Love
Right.
it.
to our doctors.
Right.
Absolutely. And so we haven't had dating advice on this show yet. So this is going to be a first for the Luxury Rental Doctor show. So thank you for that.
There we go.
So I've heard the jury giving me different thoughts around the use of 401ks and using that to leverage real estate. So my question to you is, can doctors use some 401k funds, maybe from an old 401k for real estate without major penalties? What are your thoughts around that?
I love that strategy. We have a lot of clients who utilize real retirement accounts to invest in real estate. I think a lot of people don't realize they can actually do it.
Hmm.
So they still think that for whatever reason, they still think that the only options they have are, the typical mutual funds, stocks, bonds, mutual funds that the big brokerage houses offer up, right? But in reality, investors can have what's called self-directed retirement accounts. So they can move that old 401k that's just sitting there invested in who knows what into their own retirement account that they have with a self-directed custodian that basically just means they're going to allow you to kind of go out and invest in different types of alternative asset classes like real estate. And I think the question it comes down to, or people should be thinking about, is what is my money earning right now sitting wherever it's whatever it's doing versus if I use it to open a self-directed IRA and I invest in real estate, what's it going to earn doing that? Because I know that I understand real estate and I feel like I can get a better return on my money doing it that way versus leaving it with Joe Blow, in the mutual fund 501 or whatever.
Yeah. One thing that too for any of our listeners who are practitioners, so I own my own business in the medical field, you can always consider, if you don't have any other full-time employees, you can consider a solo 401k, which allows you to self-direct that account into real estate without having to do any rollovers, right? And what we really love about that is if I have a medical practice and I can contribute $50,000, $60,000 or more into 401k, I can take it as an immediate write-off, right, to reduce taxes today. And that money could be put into real estate. And that could grow tax deferred all the way up until I retire. So it's sort of a win win strategy on getting the write off and having tax deferred growth and also having it in real estate assets.
Okay, so that's amazing. I love that. And I think it's going to get the wheels turning for a lot of our docs that are listening right now. So, another question that I get asked a lot is around leveraging long term rentals to take advantage of accelerated depreciation. And so, what I've shared with our community is I don't think that's the way it works. So, some of them are considering, what if I switch it up and put it into service as a short term rental? Can we talk about that a little bit? Talk about like an unfurnished long term rental versus a furnished short term rental, the benefits herein, and if we could even visit the midterm rental strategies, I would love to hear your thoughts around just how do we maximize our tax savings and do it in a way that is legal because mama cannot go to jail so that so that our docs can get the wheels turning because we're about to head into a season and we'll talk about like what we need to be thinking about for planning for 2026 and beyond.
Yeah.
Yeah, it's a great question, and it is definitely an opportunity that people can take advantage of. I think the main question to be asking themselves is which strategy is going to make the most sense in my situation, like Amanda was talking about. Like, are you somebody that, again, you and your spouse are both working full time, or having short term rentals is the more viable option from a tax planning perspective to utilize? Again, hey, if I can create a loss on paper through depreciation, can I use that loss to offset my income? Or are you somebody that can utilize real estate professional status for long term rentals? If you are, I think that's going to dictate kind of, do I convert that property to a short term rental? Do I leave it as a long term? Do I move it to midterm? Whatever the case may be. But once if you're definitely allowed to convert properties long term, short term, long term. There's no issue there. I think, again, it's just going to come down to which one's going to make the most sense in that person's financial situation.
And midterm rentals are just considered long-term
Okay.
rentals. So for anyone investing in midterms, those activities are treated exactly the same way for tax purposes. We talk a lot about the short-term rental loophole and how great it is, but it's also important to keep in mind that that may or may not be the best strategy for you specifically. So if you're someone who already owns other real estate or plan to own a bunch of real estate and you are going to be a real estate professional, then oftentimes, even if you're doing Airbnbs, we recommend that you have longer than average guest stays because then it's treated as a long-term rental for tax purposes. But you're
So
right.
yeah, so a short-term rental for tax purposes, the average stay is 7 days or less. If you've got, even if you're put on Airbnb, if the average stay is longer than 7 days, as Amanda's alluding to, then it can be considered a long-term rental for tax purposes. So there's a lot of flexibility there that I'm still renting it out on
Yeah.
Airbnb. I'm just getting, maybe my average stay is 10 days because I've got a unique market or unique
Yeah.
property. That could be considered a long-term rental. So in the right situation, that would work for somebody who is a real estate professional.
Gotcha. So, for someone who's not a real estate professional, we should hedge towards the less than 7 days, barring, of course, a lot of considerations, lifestyle, and the like, right?
One of the things, so the short term rental tax loophole basically allows you to keep your full time job or occupation, do real estate on
Yeah.
the side, and use the losses against different types of income or all types of
Hmm.
income. But it's not just as easy as that sounds. In order to do so, you have to meet what's called
Yeah.
material participation hours,
Hmm.
many different ways to qualify. But one of the pushbacks we hear from investors, especially people in the medical field, is I don't want a second
Mm.
job. I don't want to be doing day to day and being very hands on and being bothered with my rental
Yeah.
property. But the reality is with AI and all of the new
Yes.
technologies in AI today, there are so many ways to.
Was she, was she
I
dancing?
think there was a dance
She
that
was
just
dancing.
broke out. I'm sure you can talk to
It's
this
nothing like
more.
dancing to the music in your own head, you know?
Right.
Like, that's,
She had me at
When we're talking
AI.
about
She had me
taxes.
at AI. I was like,
yeah.
Yeah.
She had me at AI and taxes.
yeah.
Yes. But it's really important, and you could probably speak to that part of it more than even we can, that there are so many ways to self manage and be actively involved in your short term rental, leveraging AI and technologies and the different softwares where you can accomplish both, meet those hours that's required to get the benefit, but also not have it turn into a second job.
And I think just to touch on your
Yeah.
question earlier, Rachel's, if you do go convert a long-term rental, an unfurnished long-term rental to a furnished short-term rental, from a tax savings perspective, the beauty of that is a lot of the time that people are putting 25, 50, $75,000 of furniture and stuff into a short-term rental. That's all going to be immediately deductible because either it's going to be costs under $2,500 each, or you're utilizing bonus depreciation, and so that can be immediate, you know, return on your investment just from a tax savings perspective, especially if you are going to meet the material participation requirements. So that could be a huge huge advantage when you go from long term rental to a short term rental.
Love that. Love that. So I want to revisit something that we are just speaking about a moment ago. I want to revisit the fact that you mentioned material participation. And Matt, you may not know this, but I sent Amanda the most bizarre text in the world. And the last thing she said to me was, don't take tax advice from a property manager, which was hilarious. So I,
That's good
isn't that good
advice.
advice? Do you approve, Matt? So it's hilarious. So
Yes,
I was
yes.
asking on behalf of a colleague, we'll just call them a colleague. And it's interesting because when it comes to tax advice and when it comes to material participation, I think one of the biggest mistakes that some of my clients may approach again is, oh, let me just hire a property manager, right? During that first year when they're looking to meet material participation. And the property managers are hip to it. And they're like, oh, yeah, I do this all the time. You'll still get your material participation. You're fine. You're fine. So, can we like categorically define what material participation means? Because I don't want another dog to get hoodwinked and make a mistake. Because that's kind of a big deal, right?
Mm-hmm.
That could tank the whole situation if you end up hiring
Yeah.
folks who are doing all the things and you have removed yourself from it when we have a beautiful tool called AI that you can kind of set it up and get that support digitally or using technology.
I
Yeah.
thought she was gonna when she said AI. I thought she was gonna start dancing again.
Yeah.
I thought it was like a
It's a
trigger or
trigger.
something.
You
Trigger
never
word,
know, though.
yeah.
You
Yeah.
never know.
It's really interesting because so material participation, why do we care? Well, we care because you have to meet material participation
Mhm.
hours in order to use your short-term rental tax benefits against W-2 and other business
Mhm.
income. So seven different ways to qualify, but the most frequently used three. First is you have at least 500 hours on your short-term rentals. If you do, then that's it. You've met material participation, used losses against all types of income. If you don't have that, the other way to meet it is you have at least 100 hours and nobody else has more time than you. So in that context, we might be looking at how many hours is the property management company having versus how many hours am I having. That's where it becomes much harder. If I have a property management company handling my properties, what am I actually doing? How do I earn more hours than they do? And so, not to say that we can't have property managers
Right.
ever, but you just have to answer the question of how do I earn the hours that's needed to be involved in the day to day
Correct.
operations at either 500 hours for the year or more time than the property management company. And at least 100 hours, right? So, but I think the text that, just so you know, the text that Rachel sent me was the management company told the investor that as long as you pay me as a
Mm.
1099, then that's fine because my hours are your hours, something to that extent. And so, really important to understand when we say hours, they are your hours, the investor's hours. If you're married, you can combine you and your spouse's hours, but we cannot add other people's hours like a management company, our kids. Those are all other people's hours. And why is it important? Well, because if you don't know the rules, you do it the wrong way. We're not
Because
talking it
because you're taking tax advice from a property management company, maybe.
we're not just missing out on $5,000 of tax
Mhm.
savings or $10,000, right? If we're talking about short-term rentals, it's typically 50,000, 100,000, $200,000 of
Yes.
tax savings. So you just don't ever want to be doing the wrong things with the wrong
Mhm.
understanding and at some point get caught
Yeah.
red-handed because then it's a very painful lesson with taxes, interest, and penalties on top of that.
Oh, so good. So good. Thank you so much for breaking that down. I think we're saving lives today financially. So
Okay, doctors, you guys are not saving lives.
we
We
Yeah.
are.
are. We're
That's the sound bite from
yes,
today.
they're fighting for our physical lives because I've stepped away, and we're fighting for their financial lives. So I'm here for it. Love it.
Love it.
Okay, so speaking of fighting for financial lives, when it comes to March of 2026, I would tell you where Rachel circa 2014 would be, pulling together all her receipts to say, okay, please, please save me. But I've learned the hard way after getting a $42,000 tax bill that I was not prepared for, after fighting and fighting and fighting to pay down $500,000 in student loan debt with my husband, and we just were grinding it out. And then when we sat down to a tax bill of that magnitude, because we had picked up like 5 jobs between the two of us, so we were making big money, and then we got big tax burden associated with that big money. I remember sitting there at the dinner table asking him, is this a scam? Is this world a scam? Why didn't anyone tell us this? And that's when I became obsessed with learning about what real estate could do, the power of real estate. So, not letting that happen again. And I do not want that to happen to our burnt out, busy medical professionals. So, my question to you is, what is the difference, and what difference does it make to have a proactive strategy even before the year begins versus scrambling in March and April to find receipts?
Yeah, I mean, it's not funny, but in a way it is, right? But we hear some version of that story all the
Mm-hmm.
time, and it really does come down to there are a lot more opportunities in what you can do, what options you have from an investment, what your goals are, all those different kind of perspectives if you are proactive in what you're
Yeah.
doing. So have that open line of communication with your tax person, with your legal advisor, with your estate planner, the whole team of people that are working with you. Have an open line of communication, and it could be as simple as an email, like, "Hey, I'm thinking about doing this. What do you think?" It doesn't have to be a long, drawn out 5 hour conversation, but that's going to get your CPA or tax person's wheels going and thinking on your behalf versus you wait till March coming in with your pile of box and receipts flying everywhere. That there might be one or two things they can do for last year, but there could be 10 or 20 things you can do right now for this year to put the wheels in motion that are going to save your financial life.
And actually, one of the things that we always encourage people to do is what we call year end tax
Mm.
planning. And it's basically meeting with your CPA, typically third or fourth quarter, talking about what have you already done this year. Here's my income. Here's what I think I'm going to make this year. Here are my business expenses. Here's the rentals maybe I have already purchased or plan to purchase. And the goal of year end tax planning is to then come up with action
Mhm.
items. So here's my current tax liability, like you said, $40,000 or $80,000. What are the things that we should be doing in the next 3 or 4 months to try to reduce that tax bill? Is it buying a short term rental? Is it buying a new car for my medical practice, right? Is it doing some improvements to my building? So super, super powerful because like Matt said, after the year is over, in April or March even, there's not much you're doing. You're just sort of reporting what did or didn't happen last year. But before the year closes, there are so many things you could do to change your facts and really significantly reduce taxes for next April.
Love that. Love that. Well, we're about at the end here. I would love to hear from both of you. If you have any final wisdom for our listeners who are ready to keep more of what they've already earned.
Yeah, again, I think get yourself educated.
Mm.
We don't expect people to become CPAs or accountants, but you want to be able to talk the talk and have an intelligent conversation with your advisor or your team of advisors. And so get educated. We have a lot of information, free information on our website, keystonecpa.com. Can get a lot of good stuff there. We also wrote a couple books for BiggerPockets, so you can find them on Amazon or BiggerPockets. So those are we wrote those in a kind of a fun way. It's stories about what worked for clients and what didn't
Mm.
work. We changed the names to protect the innocent, but it's a easy read. It's not buried in tax jargon or anything like that. So couple different options for people to kind of find some more information.
And I just think for me, it's just making sure you set time aside to think about
Mm,
taxes, whether it's you reading a book, learning about it, but also just as importantly, meeting with your
yeah.
CPA to go over what's already happened and actually talk through it, because tax savings don't just happen magically. It doesn't just happen because your property management company told you something, right? Talk to the
Yeah.
experts about your situation. Everybody has a different situation, different goals, different numbers, different assets. So, the more attention you pay to your money, the more you get to keep and the harder it works for you.
That's a bar. The more attention you pay to your money, the more you get to keep. Oof. Dancing for that one too. That's a good one. Thank you.
Wow.
Dancing, yeah.
And I just made that up right now. I just thought that was a
Oh,
good.
first is you only get to hear it here, guys. You get to only hear.
Yeah.
I love it. Thank you so much. And we're going to add all the links in the show notes. Is that the best way to contact you? Let us know one more time. How can everyone connect with you? How can where which website? How can they get their hands on your books? All the things.
Yeah, KeystoneCPA.com is our company website. So lots of great freebies and tax updates posted there. I am mostly found on Instagram as Amanda Han CPA if you're looking for daily tax tips. And our books could be found on Amazon, Barnes and Nobles, anywhere books are sold.
Amazing. Amanda, Matt, thank you so much for blessing my community. Oh my gosh. So, guys, remember if you're ready to trade burnout for breakthrough, slide into Amanda's DMs, slide into my DMs. I'm Dr. Rachel Gainsroot, and this has been the Luxury Rental Doctor Show.